Good evening, everyone. Time for another silver update. This is a chart of Apple stock. I'm not going to really look at the silver chart because it's pretty much done nothing. Same with gold. We're in a serious sideways pattern. So we're going to look at stocks today, and we're also going to look at stock market capitalization, and then the story of the night we're going to address this and how this is related to the financial crisis. But you can see here on the Apple chart, this is just the 2-hour provided by netdania.com. You can click on the link below. So this is a fairly close chart. You can see it only goes back to about the summer. And so the big major move that you can see on this chart began at the beginning of this year. Apple launched from roughly a base of about 400, maybe 420, and has had a new angle of parabolic spike, which was just recently broken by the last breakdown that, in my opinion, is signaling the top in this stock. Now, am I right on that? Maybe. I've been wrong before. I've called tops in stocks in the .com era, and I've called tops in some others afterwards, and of course others that went bankrupt. Eventually they go down, but they don't always go down as fast as you think they should or would. And I think the famous saying is that markets can stay irrational longer than you can stay solvent. So this is the Apple stock, and it is, in my opinion, a breakdown. The test today came back up to this trend line, and my expectation is that we'll turn down. Now this rally traces back to almost all of the rallies that you can find back to the bottom of 2009. Essentially, this was the inauguration and beginning of the Obama regime. So you can see that regardless of whether Obama is considered to be a left-wing candidate as far as not friendly to the markets or Wall Street, that's clearly not the case. The Fed has been very accommodative, and I'm going to show in the story that comes up how much that has affected the stock market. So we're going to watch this chart closely because it appears to be in a parabolic situation. But then again, with parabolic situations which are approaching infinite price in zero time, you can always turn around and do another up move. The next up move, if it comes, will be something of a slope of ascent like this, which could go possibly to 1,000 or over, or we crash from here. Either way, the stock is ultimately going to crash and form a base, and then just become some type of regular company, probably in the long term about 200 bucks it will correct back to. In the meantime, you'll probably see stock splits and a lot of the machinations that you see with Wall Street and the way they jerry-rig prices and do things to cover up the ultimate result of their shenanigans. So let's go over to the question of the day, and that is from Quiet Like, and he says, answer mine please. So with that, I'm going to go ahead and answer his. He says, hey brother, I've watched your vids for some time now. Keep up the good work. Anyway, I've built my silver stack and very little gold. I recently ran up a credit card bill for education, practical skills, and Rich Dad coaching. And while I can't afford payments, it's still a lot each month, 24%, and will take a year or more to pay off. Rough estimate, paying as much as possible each month. If I had a low rate or could get approved for a new card at 0%, I'd switch in a second, but I can't, and the interest rate is really what makes this a question. My question is it wiser to sell some of my metals? It won't be all of it, but a good chunk, or hold out, eat the interest rate, and try to pay off like a madman with my 9 to 5. I was thinking that was an easy answer, duh, pay off your credit card, but maybe I'm missing something. I'm sure my coach will say sell it and recoup later. What do you say? I guess it comes down to, do you think silver will move more than 24% this year? The average in the past few years is right around there. Thanks, QL. Well, that's a really difficult question. Of course, again, I have to repeat, I'm not in the business of giving financial advice, so I can only tell you what I would do in the situation. That's definitely a difficult dilemma. I would say that if you're in a situation where you have a credit card that's at 24%, that's definitely problematic. I don't recommend that you play the credit card game unless you can play it to win. I use the credit cards and play their games, and you can use them to your advantage. Generally, though, if you're going to do that, you probably want to take a long-term view and start out with a department store credit card and buy things, pay it off on a regular basis. Get yourself one of the name brand credit cards, a Citigroup, CitiCard, Chase, or one of those, and then build that up, pay it off, and eventually you can build up your credit, the amount of money that you're able to borrow, and you can get offers and transfer. That's what I usually do, is take the balance transfer offers for the 15 months and transfer over to that. As you do that, you just go ahead and keep the other card paid off, and your credit rating builds, so you can just roll your debts over, if you have them, from 0% to 0%. Now, a lot of times when you do roll those debts over, you have to very closely read the disclaimer. If you flip over the back of your offer, you'll find the balance transfer percentage, which usually is around 2 to 3 to 5%. You don't see the 0 percentage anymore. But if you do get a 15-month offer to roll over your balance at a 3% upfront penalty, then you're looking at a 3% interest rate for 15 months. In that case, just as in the case of your mortgage, if you've got an interest rate lower than the rate of inflation, then it's not in your interest to pay that off. It's actually in your interest to carry the debt and let them lose money at the inflation rate. Now, that's clearly not the case when you're looking at a 24% rate. So that's something you really want to pay off as soon as you can, and that's up to you what you do. I guess if I had no choice, I would probably look to see if I could get a friend or somebody to loan me the money, pay that off, and then pay them off a smaller rate. Or if I had a 9 to 5, I would probably get a 9 to 5 and a 5 to 9, or I'd get something else to pay that off, kind of a Dave Ramsey sort of thing. But you definitely want to get rid of a 24% interest rate. Now, as far as stacking, I think it's important to have your foot in the door, as Jesse Livermore has pointed out. Once you establish a position, it's very important that you don't lose your position, because what happens is you find yourself chasing the market. So I would say that if you do decide that you want to sell a bunch of physical to do that, then you would keep some. I would keep some if it were me, just so that I have a position and then I can add to that. As I've pointed out in comments on the forum lately, it doesn't really matter whether you're stacking silver dimes, stacking monster boxes. What really matters is that you're stacking, and you're stacking with savings. In other words, you're reducing the amount of money that you spend, and you're taking that extra money that you save and you're putting it into physical silver, which is true saving. So, very difficult question. Those are my thoughts. So good luck to you. And I wanted to go over to the story of the night, and that's a article that's over on Across the Street. It's actually in his comedy section, and it's across the street at WordPress.com. So it's one of the WordPress blogs, and it's by Mark McHugh. And he does a very interesting thing here. He actually shows you how Elmo would show you the national debt, and I'm going to read the first couple of paragraphs and then show you the chart and talk about that. Muppets have received a lot of bad press since Greg Smith realized that he is not, in fact, a one percenter. Fortunately, Elmo's back to reclaim his rightful place in the financial world, making the seemingly incomprehensible comprehensible while politely pointing out what should be obvious to everyone not in diapers. That's not so easy when the economic views espoused by everyone from central bankers to TV talking heads can only be accurately described as infantile. It's hard to get the right answer when you're counting the wrong stuff, and maybe that's why Wall Street's minions never discuss income per capita. It's a meaningful measure of economic strength that ordinary Americans can relate to. Well, that, and it exposes pro-growth policies for what they actually are, an excuse to loot the country in broad daylight by focusing on GDP, where government money, no matter how horribly misspent, shows up in the win column. Strip away the illusion and it becomes crystal clear that their path to prosperity is our highway to hell. And he gives you this first chart, and this is just a stunning chart. I have not seen this chart before. I don't know if this comes from the Federal Reserve or not, but you can see that it is a simply stunning chart. This is two figures here. It's U.S. annual per capita income, and national debt per capita. So you can see that, and this is to Obama's credit, because you can see this clearly began before Obama, as we addressed last night covering the Doug Casey article. There's really not a dime's worth of difference between Obama and Bush, but you can see it actually began in the latter part of the Bush administration. It really accelerated in the last year of the Bush administration, and then it just started to go parabolic throughout the Obama administration. But what you can see is that the income of the average U.S. worker has pretty much flatlined since about 2006-2007, while the debt per capita has actually gone from about 28,000 or so, roughly, to 49,000. So we're looking at approaching 100% gain in that, with virtually no gain in the income. So this is a very important comparison. It's not something the spinmeisters can spin. It's very clear that the average person has not benefited from the bailouts that occurred. Now, you can say that it's trickled down. You can blame Bush or Obama. There's any number of takes you can have towards these numbers, but the main point is that the bailout of Wall Street, which again was done under Bush, has not trickled down to the common man. Now, you can also see these same figures reflected in the tax revenues, because of course income is taxed, and that's what generates your tax revenues. If income doesn't increase, taxes don't increase, so either taxes have to go up or income has to go up, and it doesn't appear that either one is going to happen anytime soon. So this is a rapid path to bankruptcy. Now, the question one would ask is, if since this financial crisis started and the government has increased the debt by these astronomical amounts, where has that money gone? It's very clear that that money has not gone into wages. So this is kind of an out for the government workers and the government make work people, and kind of a plus for the left wing that's saying that people aren't paying their fair share. Now, I'm going to dissect that, but it does give them some credence in their argument. Now, of course, the bailout of Wall Street was betrayal of conservative principles, because obviously if you are a capitalist, you believe in conservative principles, you would say that those who squander wealth should face bankruptcy. But as we've seen, the elites did not allow the big banks to go bankrupt, and that's what ultimately would have occurred, is that the big banks would have gone bankrupt, and they probably would have taken down with them every money market fund, every insurance company, and basically every financial company on the planet probably would have gone down in this collapse. But they printed up a bunch of money, borrowed a bunch of money, and bailed everything out. But that money has not gone to the workers. So where has that money gone? That's the big question. Now, if we go back to our charts, it's pretty clear that a lot of that money went into Apple. So there's its low from 2005, but you can see the bulk of the move occurred right as the money printing started. So an enormous amount of that money went into this stock. If we look at Priceline, which is the other stock that I've been covering, you can see that in the same time period, Priceline was basically a dot-com bubble stock that crashed, and then roughly in the spring of 2009, the beginning of Obama and the beginning of the major stimulus, Priceline has run essentially from 44 to about 7, nearly 800. So it's a massive 10, 20-fold move in the price of that stock. You have to compare that to the increase in incomes, which is nil. So that's where the money has gone, at least partially. Now let's look over to the stock market and its capitalization to get an idea of what these figures mean. So this is the Wikipedia article on the Wilshire 5000. The Wilshire 5000 is probably the best indicator as far as an index, a stock index. This is almost all the stocks on the U.S. market. The Wilshire 5000 Total Market Index, or more simply the Wilshire 5000, is a market capitalization weighted index of the market value of all stocks actively traded in the United States. Currently, the index contains over 4,100 components. The index is intended to measure the performance of most publicly traded companies headquartered in the United States with readily available price data, etc. Now, let's look at the price action, the capitalization of this index. On April 20th, 2007, the index closed above 15,000 for the first time, and ultimately it hit its high on October 9th of 15,806. Now, since late 2007, the expansion of the subprime lending difficulties into a wider financial crisis plunged the United States into a renewed bear market that accelerated beginning of September 15, 2008. On October 8, Wilshire 5000 closed below 10,000 for the first time, and it continued downward to the 6,772 level on March 6th, 2009. So you can see roughly in March that corresponds to this massive run-up in stocks, representing a loss of about $10.9 trillion in market capitalization from its highs in 2007, but has rallied since to the 14,400 level. So the Wilshire 5000 went from 15,806 down to 6,772, and now back up to 14,400. So the Wilshire 5000 gained approximately $2.5 trillion in market value during the first 11 months of 2009. So this represents a move. You can see it was 10.9 trillion from the highs to the lows. We're not quite back up to the highs, so maybe 8 trillion, 9 trillion. So they've added about 8 or 9 trillion dollars to the stock market. And we'll look at the Dow Jones Industrials because that's a wider one. I don't have a wider index on that, but you can see from high down to low back up to where we are, and this was the bailout of the financial system. So if they would have allowed, if they would have followed, if the Republicans really were conservatives and they would have followed a capitalistic model, they would have let this collapse. The banks would have gone bankrupt. The insurance companies would have gone bankrupt. Probably an enormous number of companies would have gone bankrupt, and you would have had something like this, where the financial assets would have gone back down and corrected to a level that is commensurate with the type of growth that we have. That did not happen. Wall Street was bailed out. And it's very clear from the chart that Elmo gives us that the money that they printed up has now flowed to Wall Street. So what you're looking at in America now is very similar to what you had happen in Greece, and something very similar to what has happened in the history of the world since the IMF has been in power, where the financial elites of a country loot the wealth of the country and either send it overseas, put it in financial assets, and then collapse the economy and bring on austerity. That's very clearly going to be the plan in the United States. You might not want to be around here for that, because it's probably going to be a very ugly situation. It appears that the government is fully aware of how ugly the situation is going to be when they finally do pull the plug, because these financial assets pretty much represent the retirement of everyone, and it's most likely that when everyone is told that your future plans for retirement are gone and you're going to have to work until you die, it's not going to be a pleasant reaction. And we'll talk to you next time.